Welcome to Chit Chat Stocks. This is our weekly Power Hour episode, and I am one of your hosts, Ryan Henderson, joined as always by Brett Schaefer. On this show, we talk all things financial markets, and it appears, although it may have subsided a little bit, markets were in turmoil this week. So we're going to be discussing what happened, talk through a bit of the flash crash that was related to the Japanese interest rate hiking, and then its earnings as well. We got tons of earnings. We got interesting comments from Brian Chesky, the CEO of Airbnb. We got Uber's quarter, a couple companies we follow closely, but I guess I should let you speak a little here, Brett. What do you have on the docket for this week?
Yeah, I was thinking of tricking the listeners and doing a title as Markets in Turmoil to get some clicks, but then not talking about that whatsoever because I think it's quite boring. And there are tons of earnings to talk about. We have Coupang, Airbnb, Portillo's, GoGo, others, I think, that we like to follow. Uber is always interesting, one that we follow as well. Plus, maybe my favorite news item of the week, something I've been predicting has no financial benefit, but Buffett did sell part of his Apple position. Trimmed, I should say, still a huge position, but
Trimmed by half.
Trimmed by half, quite large. I think we can talk about that as well. $277 billion in cash and equivalents. The interest income on that is larger than most countries. No, almost every other company, though, in the world. So I'd like to talk about that as well.
All right. But before we do, we want to talk about our friends at Public. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it is the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. That's no commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. Public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. What do we want to start with, Brett?
I think Buffett would be fun. We got a lot of earnings to hit. That's kind of the meat and potatoes, but the Buffett stuff, I think, is quite interesting. First question for you. I know I already mentioned the $277 billion. Were you surprised that he's raising cash? And are you surprised that he trimmed his Apple position by half after saying it was part of his never sell portfolio?
Yeah, I was a little surprised by the news. Not that I thought Apple was richly valued, very richly valued for a business that is unlikely to grow earnings that quickly. And it's not a knock against Apple or anything like that. It's just a matter of the size of the company and how much they already earn. So relative to its valuation, relative to its earnings growth, I thought the valuation was a little rich. So it surprised me in general that on one hand, it surprised me that Buffett owned it, continued to own it. But on the other hand, I've always seen him as someone who's willing to just hold through periods of overvaluation, doesn't want the press associated with him selling a stock, doesn't want to be seen as someone going in and out. So yeah, I guess this kind of caught me off guard a little bit. He still does obviously own a ton of stock, and $270 billion in cash, I think it speaks to how hard it has maybe become for him to make investments at a size that would actually impact the business, make reasonable, intelligent equity investments. Not that he's only investing in equities that would really impact the business. And so if he can't find anything, yeah, I think earning 5% interest on a $270 billion cash pile isn't anything too bad for him.
Yeah, I think he's telling, well, he doesn't really tell people anything. He's telling his investors maybe, or making a decision because he cares about his investors and optimizing the risk reward for them and preserving their capital while also trying to make it grow. He is saying that treasuries and the cash and equivalents they can hold at Berkshire Hathaway are a much better risk reward than Apple right now. And I got to say, I do agree with him because that business, as we've seen last quarter, no growth, really slow growth. There's a lot of risk coming down the pipe potentially, which we even saw this week with the Google antitrust stuff. There's a next step there to maybe getting the elimination of 15% of their earnings from the Google payment. I actually think it's a fairly high likelihood that that happens now. And I'm not sure that was his reason for selling. He probably thinks it's still a strong brand. But when you have over 30 times earnings, low to no growth, perhaps, stable earnings, and you can grow earnings per share by a small amount, that buyback, for one, doesn't really make as much sense at 30 times earnings versus 10. And it does not juice earnings per share whatsoever, or sorry, by just a tiny amount. And he probably said, look, I'd much rather have the optionality of cash in case we go through a huge downturn and I can be one of the lenders of last resort. And with $277 billion in cash, I think he's saying, even after our insurance operations, if for some reason there's a time period where people are selling distressed assets, distressed stakes in companies, as in the stock market, or distressed whole companies or whatever, I'll be there. And him and his team will be able to buy him. I guess he's, heading for retirement slash, is 93. So we don't need to talk about what's going to happen at some point here soon. But that is, I think, his strategy, and it makes a lot of sense to me. And if I was a Berkshire Hathaway shareholder, I would be applauding this move.
Yeah, retirement is a interesting choice of words. I don't know if he'll ever retire, but I think it just goes to show how patient he truly is. And maybe there have been opportunities here and there that are the size that would make sense for him, but he really hasn't budged on that cash pile much since the largest investment he's made in the last 10 years was probably Apple itself, right?
Yeah.
Anyway, yeah.
Well, someone is out there saying that the company is so big, their portfolio is so big, the cash pile is so big that he essentially, if this was a video game, he really came to the end of it. And over the last 60, 70 years, the track record has been so good that now he's much too large to buy all but a few companies out there, or all but a few stocks to make it relevant out there. So, hey, it's kind of nice, I think, or almost a storybook ending for someone that's, I believe, 93 years old. So coming to the end of things, and feels just about right, I think.
But he could, yeah. I'd be curious if maybe because we've got some questions in the chat here about, whether or not we think we're entering a recession.
I don't know.
Yeah, not sure. But if we are, I have to imagine that there's maybe some private businesses out there, maybe even public businesses, that end up willing to sell all of themselves to a buyer. And I think that's probably where he's going to end up finding the most opportunities. He's been buying Occidental Petroleum for like 3 years now, and it's so hard for him to up his stake, it seems, because he has to do it in just like bite sizes without moving it himself. But yeah, do you think he will sell the rest of it? Apple.
Of Apple? Stake. Ooh, that is a good question. I think if it got to, and he said, okay, let me go back to 1998. Coca-Cola was essentially the Apple of that time for Berkshire Hathaway. A huge percentage of the portfolio, huge winner, and was about 30%, I think, of the equity portfolio or larger. So very similar to Apple today, and it was at 50 times earnings. He said like 10 years later that it was a mistake not to sell Coca-Cola during that time period. So I think if Apple got even more expensive, I could see him selling all of it. But I doubt he would, unless it got extremely expensive, I doubt he would sell all of it. All right, we got some other questions. A lot of macro stuff. Maybe we can hit this quickly. If the Fed cuts rates and money market yields drop, where does that money flow? Bonds, stocks, etc. Is this a return of TINA, which means there is no alternative and you can't really get a yield anywhere else except stocks, so people flow into stocks? I think that is overrated because we've seen the market right now is approaching 30 times earnings, and bond yields are much, much higher than they were for the last 15 years. So I don't ever like that. That sounds good in theory when you hear that, but the reality of the situation, we had market bubbles when there's high interest rates, lower interest rates. I think it's more of a, how would you call it? Animal spirits versus people acting rationally, saying, well, interest rates are 2.5% now versus 5. I think some people might act like that, but the vast majority no. Uh, any thoughts there, Ryan, before I flow through some of these other questions from the audience?
No, I think I really kind of just have first order thinking here, which is if rates drop, maybe more people would feel inclined to sell their homes because they could buy something else at a lower rate. Maybe more people would feel inclined to upgrade their car because they can buy at a lower rate. Just borrowing is a little easier. So I would suspect that maybe consumer spending in general would grow a little bit, but what impact would it have on equities? I don't know, because oftentimes I'm putting this in air quotes for anyone that's listening, it's priced in. Like if everyone thinks rates
Yeah,
are
true.
dropping, it's already priced in on the forward estimates for a lot of these businesses. So does it really ultimately impact the price of equities? I kind of,
Well,
I don't
also
know.
we've seen people for the last ever since the Great Financial Crisis call things a ZERP phenomenon, which means zero interest rate policy. And people are saying, well, this market's just a ZERP phenomenon, or this stuff's trading at 40 times earnings. It's just a ZERP phenomenon. Well, ZERP is over, and there's still a lot of the same stuff happening. So I don't necessarily think it has anything to do with the interest rates. Now, I think this is an interesting one. You talked about housing, Ryan. What do you guys think happens to real estate in a recession? Do you think there won't be very many job losses, but mortgage rates will fall with Fed cuts, so prices will skyrocket? I think this is interesting, where we've seen that friction in the housing market where people have stayed put. And my hot take that I don't have very high conviction on, and I wouldn't make any sort of investment decision on it, is that if interest rates fall, that's gonna make people much more comfortable to sell because they're not gonna be afraid to get out of that low cost mortgage. And then if we're in a recessionary period where people's incomes are down, unemployment is rising, the general people's, say, firepower to buy a house goes down, I think that could really impact housing prices and would really help, you know, affordability. And someone asked about home builders. I don't think that affects them. There's still going to be a lot of supply that needs to come online, especially with, yeah, just immigration, all that stuff, and the undersupply that happened, which I do think the evidence is coming up more and more that that is the case. But I think it would definitely help in a weird way if, because people think if mortgage rates come down, that housing prices will skyrocket. And that makes sense because the affordability technically goes up. It's a lot easier to finance a home, but I think that there could be a flood of supply that's waiting to come on the market, and I don't know. There's a lot of variables at play. I think this one's a unique situation.
Yeah. We've spent, I'd say 2 or 3 years since COVID kind of talking about the housing market and our thoughts. I think I've kind of come to the conclusion that I think it's in, maybe this is a hot take, it's in a fine spot. Like it's okay. Affordability is low relative to historicals, but there is a lot of people that are staying put in their homes. Home builders have been largely unaffected by the rise in interest rates because there is the undersupply of available homes. I think if interest rates come, like, I would not be optimistic that home prices are going to continue rising at nearly the rate they have, but I would not. I think some home apocalypse, some real estate apocalypse in America seems unlikely.
Yeah, and it doesn't. An apocalypse, prices could come down and be pretty negative from inflation, and that's not an apocalypse. But there's a big difference between saying people can afford a home, people can pay their mortgage, and there's more supply coming online and inventory is normalizing, which is happening, versus the great financial crisis. That's an entirely different thing. And I would say it's a big difference between having a home being an investment versus, something you can afford, which is an entirely different matter. Another question before we get to the earnings slate this week. Why do you guys think Buffett is selling Bank of America? Simple. Stock is over. I believe he thinks it is overvalued, and he would much rather sit in a riskless asset earning 5.5%. Didn't he talk on an interview a while back? I think that was floating around this week when this cash pile update came out, that every Monday they buy something like $5 billion in treasuries, which it's got to feel cool to be one of the, just have your small little operation, well, quote unquote, small from a people perspective, buying so much of the treasury market each week.
Yeah, I'm looking at Bank of America right now because I want to see what the net interest margins look like.
And the book value, maybe?
Because I would imagine net interest margins have expanded, right? As they've been paying out. I think most Bank of America customers, they're not really in a high yield savings account. It's probably a moderate yield at most, and they're earning
Oh, I
more
know.
on
That's
their
why I
loan
keep no
book.
cash with them.
Yeah. I don't have the net interest margin in front of me, but
what about that? Book
I
value?
think it is probably pretty simple. He probably thinks there's better places to allocate his cash. Let's go price to book.
1.1. Yeah, he probably thinks their ROE is not going to be that good.
But it was,
I
think it was a little higher than 1.1 when he started selling.
Yeah,
I would guess that his selling might have been an impact to the valuation here. I don't know. Interest rates will always be a puzzle to me. What I will say is last time when interest rates rose, my initial thought was, well, people are going to expect it. They've said they're going to raise rates. So it can't impact equities that much. It did exactly what you think it would do. And especially when he cut rates to zero, not he, but the organization, the Federal Reserve as a whole, took rates to zero during COVID. Once again, it did exactly what you would think it would do. Sometimes the first order thinking there is right.
Yeah, I agree. Although it's even hard to say, like, in that situation, was it a correlation or causation? Like, what is actually happening under the hood? I will say I heard an interesting theory that 2022 and the downturn in the stock market was caused by the interest rate spike, not because people were adjusting their risk-free rate, but because of such a large percentage of invested assets are in quantitative 60-40 portfolios and target date funds. And when the bond values came down, they had to buy more bonds to reallocate because when the yields go up, the value goes down. So you had to rebalance and sell out of equities, and then the market bottomed. What makes this theory interesting to me is that the market bottomed when they stopped raising interest rates. So I think that makes a little bit of sense. But again, I don't know, and that's not really what I care about. Let's go into earnings. First question here, Ryan, from Fake Alias. Is Celsius interesting here? I bought a tiny 1% position today. Did you read the earnings report, or do you want me to go through the numbers?
Yeah, I read some of it. I thought it looked like a pretty good earnings report. Growth is still solid. Obviously not nearly what it was because it was growing triple digits, I think, for like 2 or 3 years in a row. But for them to be growing on top of this already quite large base and for them to be increasingly profitable, I think it's just becoming a more mature operation. It's bound to lose its premium. Like, I don't know what people were thinking having this at 70, 80 times earnings, or I forget what the sales multiple was. Like, it's going to be
I'll
really
bring up the
hard to
gross
grow.
profit chart for the YouTube audience right now.
It's going to be really hard to grow at the same rate they have. And so it's just the price to EV to gross profit there has gone from what looks like 35 times to 12 times in a little under a year. Yeah, like 6 months. I still think it's a good business, and I think they can be increasingly profitable. I'm sure there is some pricing power there as well. The energy drink business, to me, it's honestly kind of simple. Like, people get
Takes
hooked on
market
it.
share from soda and
Yeah.
coffee.
Yeah. The category continues to grow, takes share from soda and coffee. And people that are customers, like Celsius customers, tend to stay Celsius customers, and they're willing
Yeah,
to
well,
pay a
and
premium
they're the
for it.
ones that they're expanding the category within people that, like, aren't switching from coffee, and people want the quote I don't know if I'd call a Celsius drink healthy, but maybe they want something that's not really bad for you and laden with sugar, which the classic Red Bulls and Monsters had. So you have basically 2 tailwinds that I think can be pretty durable. The overall category expansion and stealing share from other drinks, and Celsius taking share as the leader in healthy fitness-based stuff. And 12 times gross profit? Now, people should confirm that number's right. Obviously, sometimes people's definition of EV, the platforms are just kind of taking the quantitative approach. Do your own valuation work. Although I trust FinChat, obviously, one of our good friends and indispensable platform during earnings season. I think 12 times gross profit is not crazy. I don't think it's that crazy for them. I think their operating margin can hit probably 25% to 30% at scale. Kind of invert that into that gross profit multiple, or into that whatever that revenue multiple is. I forget the gross margin. I think it's about 50%. So doesn't seem crazy to me. The growth is coming down because of that inventory buildup last year. So it looks pretty wonky, but I wouldn't be surprised if revenue reaccelerates a little bit. It's not going to get to 100%. And then we have, as Fake Alias says here, the international expansion is the wild card that can put it over the edge. I agree. That's either going to make or break the story over the next 3 to 5 years.
Yeah. Trailing EV to EBIT. Can you guess?
I'm not looking, so I'm going to say 35.
27.9.
Wow. What's the price today? Let me look at that.
It is still down.
Below 40. That is interesting. I got to say.
It is down almost 60% from its highs. I think it's a fine business. I'm glad Fake Alias actually mentioned that, because I might start taking a deeper look. I think these energy drink businesses can be extremely profitable and have very sticky customer bases. Let's talk coupon earnings. Wait, do we want to talk about markets in turmoil? We should mention this. People are going to be wanting us to mention
I want to, if I put it in the title, I want us to, and I'll make sure in the show notes to say that we actually aren't talking about that. I want people to think we're going to do the yen carry trade the whole time, do CNBC nonsense. But I mean, is there anything? I see QQQ off high, 12% off highs. Probably, that's kind of a good proxy for growth stocks. Anything in your mind, Ryan, that comes to mind that's worthwhile talking about here?
I think there is something worthwhile talking about here.
Okay.
The brokerages went down. Most of the brokerage platforms were not letting people log in when there was this flash crash Monday morning.
Not our good friends at Public, though.
Correct.
They were online.
Public was online. I'll tell you who was offline. Schwab, which really kind of pissed me off.
Yeah.
God, it is so frustrating. It just goes to show, be very particular about who you choose as your broker. It's important. And I think I might be switching in the not too distant future. So
exciting stuff.
Yeah, let that affect your Schwab position as it may. You're going to be losing a huge account.
Yeah, exactly. I think it was fun to have this markets in turmoil, quote unquote. It seemed sort of real, although I thought it was hilarious that it was mainly Japan. It's mostly recovered, and stocks are in a very normal correction. Not to say that I think they're fairly valued. I think the PE of the broad market feels, I don't know. I wouldn't be putting money into an S&P 500 index fund right now. That's all I'm saying. I thought it was hilarious that like various shows I follow that aren't investing related, where there'd be like a broader news one or some sort of whatever it is. There was like 3 of them out there that were podcasts that were like markets in turmoil or this market crash, what investors need to know, emergency podcast, market crash. And I was like, I don't understand what the big deal is, guys. Maybe I think people are searching for a little bit of a story there.
Yeah, this would probably be one of, if I would have been allowed to buy it, if there were companies on my watch list that I was maybe waiting for them to drop a little bit, this maybe would have been one of the easiest flash crashes to buy, because unless I'm getting this wrong, Japan rises interest rates, a bunch of funds that are levered to it where they're shorting it and buying in higher interest assets are forced sellers of equities, I take it. And
Yeah.
most of the businesses that I follow are largely unaffected by Japan's interest rates.
Yeah, there was a comment here from Tyler that says, I was in the real world on Monday, didn't even know the market was down until 8 p.m. Nobody in the real world cared. Yeah, nobody really cares until it happens for multiple months, or is it a giant crash like March of 2020? And especially because at that time, it was the pandemic, so people were stuck. That was when the first time people were stuck at home.
Black
Yeah, I
Monday.
totally agree. I
It was
like,
Black
though,
Monday.
yeah, no, this is there's only so many days of the week that can be a day like a Black Monday. Or sorry, like there's only 5 days of the week that it can be in history, so I don't think this nearly qualifies. 1987 definitely qualifies, but come on. August 5th, 2024. No, no one's going to remember this day. I do like, though, one of my favorite things is when CNBC or the news people or whatever talk about an unwind of a of an investment trade or something like that, where they're like the yen carry trade's getting unwound. And it's just a weird visualization. But let's
Let's
talk
start.
coupon. We got a lot of people.
How about Airbnb? Let's start Airbnb.
Yeah,
This
we
is
had a comment on
interesting.
Airbnb. You go on that one. You got some notes on it. I read it as well.
Okay. Let me share my screen. I know podcast listeners, I will describe this to you, what I'm looking at here. Go into Airbnb's financial results and sorry, I'm not even sharing my screen. Here we go. Go into their financial results, segments, and KPIs. I'm on FinChat, so shameless plug. If you use our code finchat.io/chitchat, you get 15% off any paid plans. And as Brett
KPIs
said, it's
updated.
indispensable.
Yeah, it is indispensable, and KPIs updated probably by the next day, within 24 hours when the earnings report gets released. All right, what are the numbers, Ryan? Because I see the stock's down. I think, what are we, 15% today? It's the only thing down on my watch list.
Here's the chart I wanted to show.
All right.
So total nights and experiences booked. Keep in mind, Airbnb is still, I would say, in growth mode. And they grew total nights and experiences booked 8.7%. That has been in steady decline from basically 25% growth down to 8.7 over the last 2 years. And they guided for slowing travel demand, basically. That was really what kind of weighed the stock down. Investors were very concerned that, and Booking Holdings kind of had the same concerns that travel demand, especially in the U.S., is slowing.
Yep,
So
that's what I was going to say. That's what they said. They said it was specifically North America, a slight change from the last few quarters, and they are seeing a little bit worsening in lead times, which means that people are not as confident, I guess, that they're going to do a vacation in 6 months, 12 months, 18 months. What I think is interesting and is probably the biggest question is you look at that growth rate chart. I don't think anyone expected 25% growth forever because they came out of the pandemic. There was a bit of a catalyst and, the comp was a lot easier. But what is the bottom here? What is the normal growth rate? I think maybe high single digits makes sense. Something around 10% seems like a good target for them. But it seems like, and given the stock, we're at a market cap of, well, kind of depends on what gets updated here. I mean, the PE seems to be down to 25. So I think, using that as a rough framework, that seems like people are pricing in further deceleration.
yeah, let me just I will say, Brian Chesky might disagree with you, Brett. Low single digit or high single digit might not be good enough for him. Here was his comment from the conference call. He says, I look at Apple, I look at Amazon. Apple at one point was selling iMacs. Amazon was only selling books. We've gotten bigger than either of those companies, just selling short-term rentals, but we're ready to go beyond short-term rentals. So the new Airbnb, to answer your question, Ron, will be about a lot more than short-term rentals. If he believes that they're going to enter a whole bunch of different adjacent markets, I suspect that means he thinks they can grow at a higher clip than high single digits. The other part, and this is maybe Brian Chesky might be my loser of the week after this one. On a post on Twitter, he posted something about the Barbie house, which is on Airbnb now. And then someone in the reply said, how about them earnings though? Because the stock dropped, 15% after earnings. Brian Chesky responded, said, I am confident it's a good time to buy. That is red flag waving for me.
Why? He's buying back stock.
Is he buying stock?
Well, the company's buying back stock, so his stake is going up. So technically,
I think if you go out and publicly say this, it's a loser move. That's my opinion. Anytime a CEO says it, and I know you like Brian Chesky, but if Jack Dorsey did this with Block, you'd be calling it the loser of the week move.
I don't know if it's a loser of the week. I'd say it's pretty neutral, given the fact, Reed Hastings did this when there was the short report on them back in 2011.
No, he did not.
Basically said,
no, he did not. He said, I never respond to these, but because you contribute to the same charity that I do, I will go ahead and refute the points that you mentioned in your short report. So it's a long.
Yeah, he said it wasn't a short, so it's a long.
But going out and saying, I think it's a good time to buy to a bunch of people, a bunch of individual investors, is different than refuting a short report. It's, I don't know. This is a red flag to me.
I think Airbnb does well here.
Yeah, I mean, they certainly could, but it's still, I think you could do just, if you really want this buyback to work, if you really care about adding shareholder value over time, you should care less whether or not it's a good time to buy for individual investors, right?
Well, if it's a good time to buy, he's going to buy back stock. He shouldn't try to drive it down and convince people and
you just don't say anything.
Yeah, that's probably better than this, but I don't think this is the worst thing in the world. If Jack Dorsey said this would be not in the top 10 of his red flags, or if any other CEO did this, right? I want this guy to be confident in his company. He is. I want him to be efficient with his spending. They are. I want them to have ambitions to be a larger company. They do. And there's the I think holdup that I have with a lot of companies, for example, Block, when they had ambitions to be big, but they didn't care about shareholders, where they've never had good returns. They wasted all that money on Afterpay and all these other things, and they had these goals to expand their business. But I like Airbnb because they have, one, ambitions to be big, but two, and ever since the pandemic scare, have focused on being very, very efficient as well.
I think he might be drinking the Brian Chesky Kool-Aid. I know he's a good CEO. I think he's a good capital allocator, but you put any other CEO in these comments after the stock drops 13% because you went out and said the US consumer is slowing, I think it's a bad move. But let's move on. I do have some support.
What are your thoughts? Do you think it's cheap? Is it moving up your watch list?
It's moving on my watch list. It's probably still a ways away from where I would feel.
What earnings ratio would you buy it at?
It's a good question.
It's probably like 20, honestly. I haven't done the numbers. I know I can't really do it live, but
trailing.
Yeah, I think their earnings per share is like 7.7.
It's at 20 100 times now, or that's when you would buy?
I'm saying it is now. And I think I would buy now, depending on if I have cash and there's other opportunities, obviously.
Price to earnings right now is, and this is unaffected by the working capital stuff. Wow. Can you guess what
Well,
it
I
is?
think they had some non-cash thing too.
Yeah, okay. It dropped from 40 to 17 in like 2 days. So something tells me they had something inflated there. Let me go EV EBIT because I think that might
Yeah,
be able
that's
to
probably a good one.
strip it out. EV to EBIT trailing 45.8. I think we're a long ways
Okay.
away from where I'd feel
Yeah.
comfortable
Okay. That
buying.
earnings ratio might actually be lower. Maybe it is farther away. Yeah, I'd have to run the numbers because it is a bit confusing, especially with their working capital stuff, that non-cash charge. So don't trust what I said on 20 times earnings there. I think that might be incorrect.
If you think they're growing at high single digits, Brett, 45 times
45
EBIT
doesn't make
is a
sense.
long
Yeah.
ways from where I
Yeah.
would want to buy.
Yeah, I agree on that. But I don't think I think 45 times is probably higher than it actually is. I don't think you got to run kind of your own numbers on this one. We had some comments here that's saying, Chesky is a promoter. Their icons feature seems desperate. I don't know if it's desperate as much as it's kind of they like trying to keep themselves in the news cycle, and it's not going to move the needle whatsoever. But I think it's a good quasi marketing thing that someone like Booking doesn't really do, and people in the investment community, value investors, people on Wall Street are going to be like, well, this is dumb. But trust me, the women in the United States think this is, they like this. And guess who drives the spending in the households? Them. So
It to me, I think it's a more creative way of marketing than shoveling all your money to Google AdSense. I think doing stuff like this is really just a way to stay relevant. And he's talked about that on calls before. He just wants to do stuff that's more creative so it stays in the news, that kind of thing. I like it. I don't mind it at all. But it's still a ways away from where I would want to buy it. I think it's a wonderful business. And Chesky might be a little promotional, but that's okay. Like you said, it's a bit of a marketing shtick to
they
be that
care about
promotional.
return on invested capital. They're buying back stock, and he cares about his free cash flow and earnings margins. I think that's he's showing that he cares about shareholders.
Let's talk real quickly about our sponsor again, our friends at Public. Earlier in the show, you heard us talk about the investing platform, public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This was paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
I will say, as a reminder, finchat.io/chitchat. Use that link, get 15% off. We shared those charts in earnings season. They have just the wonderful KPIs to help chart all the stuff that you're looking for. It saves me tons of time for the companies that I follow. All right. What do you want to talk now, Ryan? And we have people asking about coupon.
Let's do coupon.
All right.
I've got a thread that I think I'll go quickly through it after this that I want to run by you, which is 9 genuinely high quality companies trading at their lowest valuation in 10 years. So I will get to that. But coupon earnings, just quickly, thought it was a good quarter. The core business seems to continue making progress. It's becoming more profitable. The true profitability here is being masked by a bunch of stuff. So, and 2 of these I think you could maybe call them temporary or fine things. So the growth investments being made in Taiwan, I've got no issue with them continuing to do that and them hampering profitability there. The fine they received from the Korean regulatory department, I'm not sure what the official name is, that's temporary. And then it's also profitability is being masked by their acquisition of Farfetch. However, until they prove otherwise, and I know they've said that they're on track to improve the profitability there, that is something that could hamper profitability for a while.
I agree. Yeah. Or am I mute? No, I'm not.
No,
mute.
you're
okay. I agree. Farfetch is uncertain for them. But I did think the quarter was great as well. The legacy, you might call it, product commerce business, which is essentially just South Korean e-commerce, that's doing well, just steady growth. They're getting more mature in the market, but there's still a long runway to grow. And I think they're providing great value and have a moat that widens really every quarter. And if not every quarter, every few years, and they're focused on the right things. What excites me is this developing offerings. And I have the chart here. They hit $2 billion in revenue. Some of that's from the Farfetch acquisition, but they did get that revenue on the cheap. Losses are going to continue because of the expansion in Taiwan and you need a lot of upfront spending to build a vertically integrated e-commerce platform. But they said that they've learned a ton from Korea, that we all know how this works in every market that has the consumer spending. Amazon, Mercado Libre, Coupang, Amazon in Europe, Amazon in Japan. Like I have high confidence that they can make it work here. Yeah, Taiwan is tough because of the China thing, if they actually get to scale and it's a meaningful part of the operations. But when you see the potential here and you see the cash flow they're still generating, the cash piling up on the balance sheet, stock's at about $40 billion market cap, and I think they can do about probably $5 billion in free cash flow within a few years if they want to. Now, they might be reinvesting at that point. I mean, you got a cheap valuation, in my opinion, and a long runway for reinvestment, wide moat. Like, what else do you need?
Yeah, and if you strip out Farfetch, the developing offerings were growing, I believe, 177% year over year.
Still strong.
So
Yeah.
really strong growth, especially in the Taiwan business. I think I like where Coupang's at. It's a huge chunk of my portfolio, and I'm very comfortable with not really adding here, but I would be if I did.
I'm comfortable as well. Yeah, it is my second largest position, and see no reason to change. It hopefully will become more expensive in a never sell position over the next few years. But yeah, this is one I'm hoping to buy and hold for the long term.
Okay.
Someone says Taiwan people may have more cash with TMC growing, but maybe immaterial increase. Yeah, I mean it's a richer market than I think some people assume. That GDP per capita, income per capita is pretty good, and I think there's no concerns there about consumer spending.
Okay, 9 stocks that just hit their cheapest valuation in a decade. I'm going to go through all of them, and I'll just mention whatever valuation metric I think is relevant, and you can chime back with what interests you. Number 1, Amazon. EV to EBIT, EV to trailing EBIT, 33.7 times. That is the lowest in a decade. Number 2, Salesforce, EV to EBIT, 35.2 times. EV to operating cash flow, 19 times. So still fairly expensive. 3, company we've discussed before here, Nike, EV to EBIT, 16.5. Number 4, I bet this one's piquing your interest, Block, EV to, they're not very profitable, so it's kind of hard to choose a metric here, but gross profit, EV to gross profit is 4 times. Number 5, Lululemon, EV to EBIT, 13 times. This one continues to drop, which shocks me. Number 6, Evolution, the one that has all the gaming, the iGaming casino operations that it powers a bunch of the other apps.
Yeah, the back end for online casinos, right?
Yeah, and it's still a $20 billion market cap business. I believe it's based in Sweden, and it is very, very profitable. I remember looking at that, like 70% operating margins or something like that. EV to EBIT 14.6. So if you believe in the future of this business, it seems like a very attractive price. Number 7, Ulta Beauty. Number 8, Wise. And number 9, Vail Resorts. Are you familiar with Vail at all?
Yeah. Owners of Stevens Pass in Washington State. Did you know that, Ryan?
I did.
Yeah.
They
decent business, but the skiing's tough, or the mountain resorts are tough just because of each year you don't know. I don't know the weather. You're at the whim of the weather, I think, which seems like something that I would not want to be a part of.
Yeah, it does make it very difficult on any given year.
Great physical mode, though.
Yeah, very much a physical mode. It's hard to it's hard to develop your own mountains.
Exactly. Saudi Arabia tries, but that might be the only competitors in there in the middle of the desert. I'll tell you
Yeah.
what makes. I mean, I got 3 that interest me. One shouldn't interest me, but it does. 1, Amazon. 2, Wise. Although I saw their fees seemed high for a transfer we were trying to do, and I hope they keep lowering those because, you're supposed to be the anti-PayPal, not increase your fees to match them. But the third one, and this is one that's getting harder and harder to resist, is Lululemon. I feel like it's going to work here, but I just don't. I have a hard rule to not invest in apparel.
Yeah, I think it'll work here as well. It's very tempting, but
Gut feel, yeah.
so far my no apparel rule has served me well, and I think I might stick with it.
I
I
think
just avoid Lulu.
if it goes below 10 times, I'm in. I'm going to say it right now.
How about Ulta? 10.8 times EV to EBIT.
I think it probably works, but I'm a little bit more worried, shockingly, now that I've done a little more research about competition. I think online might. They just have a lot more work to do to reinforce the customer. I don't want to say flywheel, but just customer retention and building any sort of mode. I think it's kind of even weaker than Lululemon's mode, which if they have either of them have any. And I think Lululemon's, it's a brand mode. And I think it's a good brand, but brand modes are weak, in my opinion.
Any other earnings we want to get to, or can I discuss my small cap of the week?
Well, I do have Portillo's, but why don't we save that for the end if we have time? I think we will have time. Let's do your small cap of the week. Looks like an interesting one, and maybe talk about our sponsor after as well.
Yeah, this was sent to us by a listener. He sent the ticker, he or she sent the ticker EGHSF, and it's ENG House Systems, ENG House Systems. It's a group of small businesses organized into 2 different segments. I'm reading this off of something from online. The 2 segments are Interactive Management Group and Asset Management Group. The former, so Interactive Management, focuses on software for contact centers, customer service, and video solutions for different applications. And then the latter provides operations business support systems for telecom, media, and utility organizations, among others. If Brett, if you're able to share the revenue chart that I've got here in the document, it's actually grown pretty quick. This is a Canadian business. It's gone from $220 million in total revenue to $480 million over the last decade. However, as you would imagine with remote contact centers, growth skyrocketed in 2020 and 2021, but it's since kind of dwindled away and it's starting to grow again. The difficulty here is that, and here's what kind of worries me. So 2 things. First of all, they're in the process of a SaaS transition. They are going from a traditional licensing model to a subscription or software as a service. And it's been okay. It's been added some pressure to sales, but at this point, SaaS is like 70% of the business. So it should help them over the long run. The other part that concerns me is they are a quote serial acquirer. It just makes it hard to value. And especially with small caps, and I'm kind of learning this now working in a software business, you are disadvantaged as a smaller software company. Like in the contact center business, when you are the premier player, those are the ones that those will be able to grow faster. I think, I can't remember who it was, but someone came on her show and we were talking about the 3 big cloud providers, and he said the big get bigger in tech. That's just really the way it works. And I kind of didn't understand it at first, but yeah, you have so much more resources. There's a lot of social proof as well in the buying decisions for a lot of these companies. Like they'll ask, who are your other customers? And they really want, okay. For some, they don't care. They care about, are your other customers competitors of ours? Because if they're using it, then we'll use it. And it's easier for big companies to get bigger. So having kind of this hodgepodge of smaller assets scares me a little bit. However, They do pay a consistent dividend. The dividend has grown consistently since 2008.
It's a nice
And
chart. Very
yeah,
nice chart.
did you share that one as well? It might be worth sharing that.
I didn't, but let's just say it goes up and to the right.
Yeah.
I think people can understand that one.
It's at about a 3.6% dividend yield. Current EV to EBIT is 15 times. I think you can get a solid return from here, especially with there's the stability provided by the dividend here. But I wouldn't say it's my favorite small cap that we've looked at yet.
Yeah, or go ahead.
I was just gonna say, and if you want to find reports on any of these companies, like let's say someone pitches you a new stock, I'm telling you, just go to joinyellowbrick.com and just look up the ticker. You'll find some high quality report from someone that has written a report or discussed it on a podcast, whatever, across the internet. It's just like a really, really useful directory for high quality stock pitches.
Oh yeah, and hop on that email newsletter they have too. It's fantastic. I get one every day. They update the database, and you can search for small and micro caps, which are so hard to look at and find. And it's all about saving time and helping you turn over as many rocks as possible. Yellowbrick definitely helps you do that, and it's yellowbrick.com. Link is in the show notes, which you can find at yellowbrick.com/chitchat. We had a question here: have margins gone up or down? They've actually gone down. Gross margin was a peak of 72 down to 66 now, and operating margin was at 24 down to 19% now. Some people might look at that as a bad thing, but honestly, that could be a good thing if you think margins are going to revert higher because the stock doesn't look that expensive on a trailing basis. But yeah, I can agree this one doesn't really excite me that much. I like small caps and micro caps that are either huge growth potential or at a extremely cheap valuation. And this one doesn't really seem to fit what those two criteria.
Yeah. No, it isn't. All right. Do you want to talk Portillo's? Your the next Chipotle, as you might call it?
That title, I guess, some under the hood stuff is one that actually worked quite well, unsurprisingly. On the YouTube SEO, we get like 30 views I think like 50 new views every week on that one, and it was released 6 months ago. But yeah, Portillo's, people don't know, Chicago-style food. It's been in Chicago for multiple decades and now is trying to expand to new markets, specifically Texas, Florida, Arizona, in the Sun Belt space, and eventually all over. They have less than 100 stores, so it's still early in this, and there's a lot of things to prove out, and the stock is cheap because of that. I'd say it was a fairly boring quarter, 7.5% revenue growth, negative 0.6% comp sales. So they're facing a tough slowdown, like a lot of other restaurants are. They said things have been choppy in 2024 and a bit unpredictable, which restaurants have said as well. They still think there's plenty of capacity to grow their stores. Margins are solid at their restaurants. And one key thing I saw in the earnings report that not necessarily a surprise, but kind of a nice little check, is that they have positive $41.6 million in operating cash flow so far this year. And I'm looking closely at that every quarter and making sure to track that because they need to have the internal capacity for CapEx spending. Two things I thought were interesting. I'll read these quotes from the conference call. They have been trying to improve their operations because they essentially went from like a small business almost, or like a medium-sized business, and now they're trying to set up their operations to be really prepared to go from 50 stores a few years ago to 500 stores 10 to 15 years from now, and that takes a lot of work. So one thing is they're talking about their managers and the bonuses they pay them. Here's the quote they say on the conference call. Store managers at Portillo's are bonused on sales, and the way it's communicated to them is the old Texas Roadhouse model. Not too proud to steal a great concept. They get a percentage of the incremental profit that they generate for the company. Texas Roadhouse has done quite well, so I think that's a good sign. And I like that they simplified the bonus model to say, look, your restaurant hits X number, we're going to give you a bonus. You hit another one, we'll give you even more. They also talked about, this is a negative, but maybe they tried to spin it into a positive, as they said their customer experience at the drive-thrus has deteriorated. So on a positive note, it means a lot of people are visiting their restaurants, right? It's a popular restaurant, but on the second, you got to take care of your customers, not have them sitting in that line. So they said, quote, in 2019, we were almost a minute faster in our drive-thrus than we were in the past trailing 12-month period. And in a very quick period of time, we've carved back 15 seconds of that time. and they see more opportunity and drive through improvement. So they think that can help comp sales. They think their new marketing stuff can help comp sales as well. AUVs are fine. They're sticking around 9 million, which is good. They haven't grown, but it's still best in class. And they've confirmed that the new stores are going to have lower square footage is the right term for it. So 20% less square footage, but similar AUVs. And the CapEx guide came down, even though store count is supposed to grow at the same amount, which I thought was a good sign as well. Hopefully that can help with return on invested capital. I'd say all around, not really any surprises in this quarter. And I still think the stock is a good risk reward. It's definitely a riskier one, though, I should say. Don't, if you only like blue chip stuff, do not invest in this one.
No, it does feel like a concept that has legs and could scale nationally, but kind of remains to be seen. They are sort of employing the model already. We just got a comment in here from Andrew, a friend of the show, says, "What's up, guys? Coupon earnings were great." Yes, I agree. And I believe the market agrees today as well. Brett, isn't that correct?
I think, yeah, they were down after hours, but I think it's up about 6% last I checked. And yeah, Andrew is a part of the capital mind. That's the right term, right?
Yes.
Capital mindset or mindset capital.
No, it's capital mindset.
Capital mindset.
I believe. Maybe Andrew can correct
check
us
them
in
out.
the
They
chat
actually do
here.
quite good stuff. Very similar to us. I know there's a lot of YouTube channels out there that are very promotional and stuff. Yeah, they do quality work, and I like watching their stuff. So, Ryan, back to Portillo's. What'd you think?
It was fine. It was kind of a lackluster quarter. Like they added one restaurant. AUVs didn't move a whole lot. They're lapping difficult comps, so kind of hard to tell. I do want to talk about Uber earnings real quick. This business, it's becoming a monopoly. I think it's working at this point, and it's becoming increasingly profitable. This was a business I always wanted to hate, but they've done a very good job executing. And really, I've hated them just because of the adjusted EBITDA metrics that they choose to use, segment level adjusted EBITDA, which just is basically revenue.
The CEO wears turtlenecks like Steve Jobs, which a little bit of a turnoff, I gotta say, but that's not a serious turnoff. I just think it's kind of funny.
He is a disciple of Barry Diller.
Yeah. Is that a good thing or a bad thing now with how bad IAC companies and their spinoffs have been doing? But no, I mean, he's done a good job. He has a great track record.
Yeah, I don't know if there's too much to discuss here. I think the thing that's maybe an interesting development is that Uber has catered more and more to the affluent over time. It appears that I think initially when it came out, it started as a service that was meant to be solely for the affluent, exclusive black car services, get picked up, from an app, very simple, felt luxurious. Then it kind of said, let's be the ride hailing service for everywhere and kind of enter at a low price. And now it's beginning to price out a lot of customers. And they even said our consumer wasn't nearly as affected as a lot of the other businesses have described. Amazon on the earnings call this quarter said the consumer, especially in the US, is being more discerning with their spending. We've seen that
cheaper
from a
items,
number.
right?
Yep. We've seen it from a number of other companies as well. McDonald's, for what it's worth. McDonald's, Starbucks. Consumer spending is tightening. And Uber basically said they're unaffected.
Yeah. And for any of the listeners, you can hear the pleasant sounds of Seattle in Ryan's background there. But no, that always goes away quite quickly. Uber is a good business. And I think I would be very attracted to it, maybe more attracted than even an Airbnb. But I do like Airbnb more for one reason, and it's because I'm pretty bullish on Waymo.
Sorry, I was on mute there. Do you remember our bet?
Yeah, the Airbnb versus Uber one. It's kind of like one of those races that's going back and forth. Where I was at Airbnb one winning. Airbnb was winning, and now Uber's winning. And then, like, if you go back, it's kind of flip flopped for each year.
For context, for all the listeners, I believe in 2019, 2018 or 2019, Brett and I made a bet, and I guess the bet is since over, but it was, who do you think would have the larger market cap in 3 years? I think is what it was.
Was it 3? Yeah, it could have been 3, maybe 5.
And it was Uber or Airbnb. I said Uber. Brett said Airbnb. I think they were like close to tied.
It was really close. Yeah. Now Uber's pulled away a lot, but
yeah, Uber's at 139 billion, and I believe, let's see, Airbnb 70 billion. So about twice the size. So I don't know if I can take a victory lap on this since it's a little longer than our.
Well, yeah, it could be a perpetual bet, almost like a psychological long, psychological short. Could be fun to have the update. And I think they're both fascinating businesses either way. But yeah, someone said here if autonomous driving didn't exist, I would be all in on Uber. I sort of agree. I think that's a big uncertainty there that doesn't exist. And Waymo is sneakily expanding to a lot of surface area in some of these cities now. So I just, if you like Uber, I would just make sure you have your eye on that. Maybe it won't matter, but something to watch out for. We have one question here I want to hit though, Ryan, as we go over a little bit. Someone asked this on Twitter and in here, so I want to hit it. They say, hey, Brett and Ryan, how should we measure a company's capabilities and management's willingness to do buyback in the context of free cash flow and stock-based compensation? Which metric do you prefer the most? Buyback equals do buyback if it's buyback divided by free cash flow, buyback divided by free cash flow minus SBC, buyback minus SBC divided by free cash flow, buyback minus SBC divided by free cash flow minus SBC.
This is great audio, Brett.
Yeah, sorry, I was just reading the question there. I would simplify things and just say, talk about the earnings yield without the stock-based compensation. But when you're looking at a buyback program, I like to think of it as you have a headwind coming in from the stock-based compensation and maybe look at the historical dilution rate. So say the historical dilution rate is 2%, but they're at a free cash flow yield or a earnings yield of 8%, and they're going to spend the majority of that on buybacks. So let's say they can reduce share count by 6% a year, something like that. Just net that out. Take the 6 minus the 2 and say, I think that they can reduce shares outstanding by 4% a year, and then add that to your earnings per share and free cash flow per share growth targets. I like to do it like that because that's earnings per share growth and free cash flow per share growth are what is going to matter over the long run.
It's not a perfect formula, and really, I don't know if there would be a perfect formula. You could do like buybacks minus stock-based compensation, but that's not perfect either. So,
right,
because of the way, I mean, stock-based compensation isn't always exact in terms of like how much it's going to dilute, because there's,
and you don't know where the stock price is, and you don't know how many options are going to be able to be vested. Right.
Sometimes it's forward assuming. It kind of depends. I'm not exactly well versed in the accounting for stock-based comp, but it's not a direct correlation to dilution. So I agree with Brett. Take the historical dilution rate. So share count you can literally just go on FinChat and just look at the share count and see the annual growth rate. If the share count has grown at 2% a year, and you think they could buy back 6% of their stock, the comfortable assumption there is that the share count could decline by 4.
Now, the one caveat is if they're already buying back stock, you can have a situation where they are someone that dilutes, but they also buy back stock. Well, then they've done the math for you, because unless the valuation has changed materially, now if the stock's gotten more expensive, maybe you should lower that buyback impact, but if it gets more cheap, you should increase the buyback impact. They'll already have a declining share count for you, and that'll kind of tell you, like, look, if the valuation hasn't changed, if the buyback framework hasn't changed, and the SBC hasn't changed, well, I think that's what they should be able to reduce their shares outstanding at the same rate as they did historically.
Hope that makes sense. Hope that helps. It's always nice to do maybe a little more of an educational segment as well, instead of just riffing on the world of financial news. But I think that's going to do it here. So I will take us out. Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Stocks is not formal advice or recommendation. Brett or I may buy, sell, or hold any of the securities discussed in this podcast. Thank you for tuning in, and we will see you next time.